For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, rock and roll, rock and roll. Does anybody say rock and roll anymore? I don't know. It was a big, it was a battle cry, Professor Plum, when you and I were kids. Rock and roll whenever you walked into a room. I don't even know if people know what rock and roll is anymore, at least true rock and roll. Anyway, hey, welcome to the podcast. This is not about rock and roll. If you tune in for that. Professor, we've always said we were going to do a show one day about movies that we love, songs that we like, song lyrics, movie
TV
quotes,
shows.
TV shows, as we were just discussing MASH before we came on the air. And once again, very, very few people who are younger than us know what that means. But hey, maybe someday if we have enough clamor for it. But today's discussion really is relevant to certain people, but I'm going to make this relevant to everybody who's listening. At least I'm going to try. The topic for today, and by the way, it's a new season. I should tell people this, another new season. I know we've been off for a couple of weeks, but we're back here with brand new episodes. With season, I don't even know what it is. It's like 20 or 58 or something. Doesn't matter. We are back. But somebody keeps track
20,
of these.
58, whatever it takes.
Whatever it is, somebody keeps track of these things. We're going to be talking about pension options today. And I was trying to find out how many people have a pension. And it's actually, as a percentage of the population, Rick, it's not a huge percentage of the population, but oddly enough, certain industries are it's government employees. Many of them have pensions. We have teachers, we have union members, we have like firefighters and police officers and that kind of thing. So while it doesn't cover a huge section of the population, it still is. They still do have pensions. And, there are important decisions to be made when you have a pension. And I'm not going to relate this to bucket one because I think you would agree with me. The pension is not part of bucket one, is it?
No, it's not part of bucket number one. It's outside of bucket number one because it's a direct income source that you can't screw up. You can't invest to make better. You can't do anything about it. It's like your Social Security. Is Social Security part of bucket number one? No, it's a direct income source. It's a foundational issue. It is something that you look at, you understand, and you have to plan for a pension because there's lots of different options. The same thing with Social Security for that matter, with when do you take it and things of that nature. But once you've made your decision on when to take it and which form it's coming in, life only, joint survivor for pensions, then it's a matter of it's fixed. Nothing you do from being a good or bad investor, good timing, bad timing, lucky, unlucky, markets up, markets down, none of that changes that monthly check, which is probably a good thing. And so it really is not part of the buckets plan. I remember 10 or 15, maybe longer, years ago, there was a big push for people that managed stocks, basically, to say that Social Security was like a bond portfolio. And so if you look at the value of Social Security over time to what it is, like if I retire today and I'm getting $2,000 a month from Social Security over my life expectancy, that's worth several $100,000 to me. It would take the equivalent of several $100,000 in an investment today to give me that same income stream for the rest of my life, especially with the potential inflation adjustments. So if we looked at your portfolio, if you have $500,000 and you've got this $400,000 of present value of Social Security, you're in a balanced portfolio already because of the Social Security. So you can be 100% stock. That was one of the stupidest arguments I've ever heard. And luckily it didn't last that long. So treating buckets or treating pensions and or Social Security as part of your buckets is not appropriate. It is not something that you do. It is very important to understand what your pension is going to be. It's very important to know what the Social Security is going to be because that dictates how much of a shortfall you will have once you've turned on those direct income sources, that shortfall that needs to be covered by distributions from your portfolio, which dictates how your portfolio gets invested. But you can't change the investments within your pension. You can't change the investments within your Social Security. So it is an outside income source that we have, but it's, like I said, it's very important. We need to understand it. We can't ignore what a pension does for us.
Well, let me tell you why.
That I'm receiving one.
Yeah. Yes. You see? Well, and this is why, because when you make your decision for your pension, I mean, that's it. That's what your payment is going to be.
It's set in stone.
It is.
For the most part.
Well, yeah. Now, Social Security, you can potentially, undo a couple of things here and there, but with your pension, you need to make the correct decision, an informed decision, which is why we're going to be talking about this today. So, generally, Professor Plum, what are your options? The way I see it, you have a lump sum option or you have the annuity option. Yeah.
And not every pension offers a lump sum.
Well, let's explain some of these. Let's explain what people's options are, and then just kind of talk about how you decide what you want, whether it's option A, B, or C.
Well, if you are working for an employer who offers or has you participate in a pension of some form, what you're going to be told is you are going to receive a pension of X amount of dollars, or you're going to be given a formula for determining what your ultimate pension will be at some point in the future. Typically, the formula is the number of years of credible service you have with that employer times a percentage factor times the some calculation of your income. Usually it's the average, the best 3 years of average, the best 5 years. Some are the highest year income that you had. I mean, there's different ways. So knowing what the definition is of how it works. Most pensions are set at a percentage. So if I have 20 years and I get 2% of salary, that's 20 times 2, I get 40% of my salary when I retire at a specific age. That percentage will change based on how old I am when I started, and it'll be smaller if I started early and larger if I receive it late. Now, some union pensions are a flat dollar amount per year of service. It doesn't matter how much you made. It doesn't matter whether you were, a high end, making $100 an hour, or somebody making minimum wage. It's based on the number of years of service times a dollar factor, and that's what your pension is for the rest of your life. So the first thing you need to do is figure out, what am I working? What is this benefit that I'm working for? How are they going to calculate it? And so then look at and they're going to look at it as, this is what the formula says your pension will be at a specific future date. Maybe that date is tomorrow because you're retiring tomorrow. But that's based on one thing, based on your life. It's a single life calculation. Now, if you're married or you want to base the pension on lasting for both your life and somebody else's life, they're going to change the formula a little bit. They're going to say your age basically changes a little bit, because if I'm insuring two people, if I'm going to make a payout, John, if I'm going to make a payout to you for the rest of your life, the odds are that you're going to live at age, whatever you are now, you're going to live X number of years. Mm-hmm. But if you're married and I have to guarantee it for both your life and your spouse's life, the odds of both of you dying in that projected period of time is less than the odds of one of you dying in that projected period of time. So it's likely that the pension's going to have to pay out longer than just your life. And so what they'll do is they'll say, well, that's not going to work for us. We're going to basically say, we're going to give them the actuarial equivalent and say, well, if they're going to live longer, we're going to give them less money, so that over the projected life of this payment stream, they'll receive the same amount of money. So the first thing is find out what your formula is, what my single life pension is. Now, if you're single, you can run with that. Now, if you're married or you want to, in some places will allow you to add a partner to this, not even a marriage issue. How old is that person? If they're older than you, it's probably not going to have much to do with your calculation. If they're younger than you, you're going to get a discount. You will receive less per month than the single life pension. So when we're doing our planning, we have to look at which pension option we're going to take. A single life, but then what happens if that person dies, if that proverbial Mack truck finds them the day after they retired and made an irrevocable decision, that pension stops. Can the survivor afford to live without that income? If the answer is no, how much income does that survivor have to have? How much insurance, basically, do we have to provide for that survivor so they can live if worst case scenario happens or something of that nature. So we're looking at what percentage of that income that would be going to the retiree needs to continue. Generally, it's specified in 50%, 75%, 100% joint and survivor. So they're saying that if it's a joint and survivor, it means that something's going to continue after the first one of them dies. Meaning, let's say my wife and we have a pension, I have a pension. Joint and survivor, I mean, life only was $2,000 a month. Joint and survivor is $1,500, and it's 100% joint and survivor. That means that regardless of who lives, it's going to continue. If it's only a 50% joint and survivor, the discount won't be as much, but only 50% of the pension is going to continue.
Right.
And 75%, and so on and so forth. So it's all a give and take of how much can we have. The likelihood is that I'm going to live for a long time, and I'd like to get the highest monthly benefit that I can, but I need to provide something on the other side. So we have to look at how, and then choose which probably the more appropriate one to do the planning with, because that tells us then how much money we need from the portfolio and how to set up the portfolio with the rest of the things. So understanding your options. Some places, and one of the big kickers is, if I am the pensioner and I take the reduced pension so that if I die, something continues for my spouse, and God forbid my spouse dies first.
Yeah.
In many cases, my pension is still cut, limited for the rest of my life.
Yes. In other words, you took instead of $2,000 a month,
I took a cut in my pay to provide for my wife if I died too soon, but I also took a cut in pay in case she died too soon, unless the pension has a pop-up option. I mean, these things get carried away. You can have it go back up to the original life-only option. But there's a price. Not all of them work the same way.
And there's a price for all of this, is what you're saying, because the single life, I guess, is generally the highest payout. At least that's kind of what I've seen for the most part. But the more you want to add, the longer the benefit potentially has to last, the shorter the monthly payments are going to be. And I think people probably say, yeah, I mean, I kind of get that. But
it's like Social Security. If you take it at 62, it's a lower number. If you wait till 70, it's 76, 78% higher, because you're expected to receive it for a shorter period of time. Actuarially, the Social Security Administration doesn't care, because based on the law of large numbers, they're going to pay out the same either way. They're going to pay you less from 62. Let's say you live to 82. Over the 20 years, you'll receive X. But if you don't start until age 70, you get a bigger number from 70 to 82, but the reality is you get the same amount.
Yeah, and so when you're trying to determine this for your pension, though, is it the factors you really need to look at are age, maybe your age, if you're the pensioner, as you said, your age versus the age of your spouse, if you want to continue a payment for them, maybe somebody's health, sure, somebody's
very
health.
Much so, yeah. You want to look at health, look at lifestyle, Are you a crazy person that is out, hang gliding or squirrel suit jumping and base jumping at age 85?
Yeah, you're an anthrax taster, and
tester.
Whatever it is, I mean, these are the things you have to. And a family member of mine did this, and the next generation up, a member of mine decided he wanted his wife to have as much, it was her pension, and says, okay, I want you to have as large a payment as you possibly can. So it was single life. Well, she unexpectedly died before he did, and that pension went away, which created some challenges for his future income. But these are the things that you need to take into consideration
you take into consideration all these options, and you come up with the best logical conclusion for you at the time you're making the decision. That's now your baseline. And when you're doing your planning, that's what you plan on. Now, in many cases, not all, the pension will also offer a lump sum that says, instead of giving you $2,000 a month, we're going to give you this lump sum of money, and we're not going to give you a monthly payment. You can do whatever you want with it. But instead of giving you any monthly, you just have a lump sum. Now, our hands we've washed our hands of you. We are done with you. You're out of here. It's up to you to create or spend your own money the way you want to spend. Lump sums can be great, but if you're not at retirement today, you really can't make the decision to take the lump sum. You can take the idea. You can say, if I were retiring today, and I looked at the numbers today, the lump sum looks better, but that doesn't mean that lump sum, and many times they'll give you the projections. If your retirement's in 5 years and we project you having X amount of dollars per month or a lump sum of Y, and you're looking at that going, I like that Y. I'm going to take the lump sum. But then 5 years later, you get out there and the monthly benefit is the number that they said it was, but the lump sum is not as big or has changed, because the lump sum is based on the interest rates at the time of the distribution or within a several month period of time around it. 5, 6, 7 years from now, interest rates may be very different than they are today.
Explain then when interest rates are high versus interest rates are low, just very quickly. When the lump sum is better.
The lump sum calculation of a pension is based on the monthly payout. The monthly payout is the known number. The monthly payout, the pension, is what is being calculated by the formula. The formula says this is the monthly payment that based on your age, service, and all that stuff we talked about. And then they do what's called a present value calculation. The pension does, and they say, in order to pay out that amount of money based on today's interest rate, you need to have a pool of money of Y amount of money to be able to pay that X out. Now, the higher the interest rate, the more that lump sum can earn, the less that it needs to be to make the same monthly payment. Mm-hmm. We're dealing with certain variables, but certain knowns. And so what is known is the payment is known. It's the present value that's different. The higher the interest rate, I mean, if I had $100,000, I could pay out $1,000 a month. If I could earn 10%, I could pay that $1,000 a month out for quite a while, as compared to if I could only earn 2% on that $100,000. At that $100,000, I can't pay out the same dollar amount for as long. So the interest rate is a very important issue. We saw this happen a lot 5, 6, 8, 10 years ago. Lump sum payments were much more enticing than they are today. Why? Because interest rates were basically zero. You couldn't earn anything, so it had to be a very large lump sum to make the payments. Mm-hmm. Now that we're in the 4 or 5% range, give or take, and that lump sum can actually earn something, it doesn't have to be as big to make that same monthly payment.
So when you say
interest rates change.
So when you say that it's based on an interest rate, but somebody's not going to be getting their pension for another 5 or 6 years, it's the interest rate 5 or 6 years from now that we're talking about. That will determine.
They may be calculating it based today as a projection based on today's rates, but that rate can change. But like I said, that rate is unknown at this point, but they're using it as a placeholder. If interest rates were the same today as they were when you retire 5 years from now, the lump sum would look like this. But we reserve the right to change that lump sum if interest rates change.
So when you look at
the formula specifies the monthly payment.
Yeah. So when you look at your pension projections, and you still got another 3, 4, 5 years, or whatever it is, even longer, you really don't know. These are projections based on current economic or interest rate conditions. But those numbers, both the monthly, I guess, can change. The monthly can change. Correct.
Well, the monthly doesn't change by economic conditions.
No, but it changes.
The only thing that changes the monthly is, remember, the monthly is based on years of service
and your salary.
If I'm going to work for 5 more years, I know what my years of service are going to be. Yeah. My monthly is going to be based on my salary, and unless I'm going to get dramatic increases, my salary is, for a lot of people, is fairly well known for people that have pensions. So that's only a minor league change, and my age, and that's known. We know what my age will be in 5 years, assuming I make it that far.
So if you're retired, let's say you retired at age 61, but you're not going to take your pension till age 65. You want to wait till the maximum age, and you look and they tell you, okay, your pension will be $2,000 a month, whatever it is, and you get this at age 61. If you don't work ever again, and you make it to age 65, that monthly payment will not have changed. Is that correct?
As I mentioned earlier, I have a pension. Yeah. I started it last year. And I've known what that pension was going to be for 30 years. The factor hasn't changed since I since 1986 or whatever it was when I left my union employment as a grocery clerk.
You mean you weren't going to go back to working at the Alpha Beta grocery store?
If I had gone back, well, I don't think they exist, but if I had gone back and I had become part of the pension again, my pension obviously would have gone up because I would have had more years of service, and the new contract that's being paid each year gets a higher amount. Now, the previous years would have still gotten the same amount, but so no, my pension's been set for 40 years almost.
Yeah.
It didn't change.
Yes, and that is the monthly payment. Now, both your pension and my pension from these old jobs are not very big, so this whole lump sum versus monthly thing is really kind of a moot point.
And
but
they didn't offer a lump sum to me.
No, and I didn't. In fact, I can't even take mine until 65. They don't even offer an early. You have to do it at age 65 based on my years of service. But regardless of that, if we wanted to boil this down, and I wanted to make sure people who have pensions understand, if you wanted to boil this down into something quick that says, here's how you decide. We've discussed already. We've already discussed single life.
Lump sums are the tricky. Lump sums are tricky because if I'm retiring today, they may give me my pension. I could defer taking it. Like you said, you're 61 years old. And if you don't want to take your pension until 65, it's going to be X amount of dollars. But if they're offering you a lump sum today, they're basically saying, we'll give you this money today. So you have to find out, are they offering that lump sum today, or is that the projected lump sum at 65? Because it might be, you say, and then you have to calculate and just do math. I know that it's a four-letter word, and a lot of people don't like four-letter words, especially ones that sound like math. It's a matter of, if I had that money today, and I let it alone and let it grow for 4 years from 61 to 65. And then I started taking out the same dollar amount based on certain assumptions. How long would it last? Does it make sense to take the lump sum, or is the monthly pension a better deal? It's not always the same answer, even with the same pension, even with people the same age. Some people prefer that monthly check, and they say, you know what? I don't want to have to worry about investing the money. Other people may say, you know what? I have other income, and this pension monthly amount doesn't mean that much to me. I want to invest the money. Even though they may have two people that are 61 years of age. They have the same number of years of service. They have the same salary. They have the same projected pensions. If there's a lump sum offered, one of them may be better off in their minds with the lump sum, and one of them may be better off with the monthly payment.
If you have somebody who, if you
emotional.
It is, but it also may be somebody with a family history of not living too long. Maybe somebody has health issues. They may want to. Would they perhaps consider the lump sum so they can potentially have
leave something for their heirs?
Yeah.
Yes.
Yeah.
That's where we talked about earlier. One of the factors that comes into play is life expectancy.
Health.
Your health, and if you're already that your life is not going to be that long, unfortunately, then a joint survivor 100% makes a lot more sense if you're married, or the lump sum if it's available. At least then you could leave something for your kids or your heirs or whoever it is. So there's ways and all of these come into play when choosing. Now, that doesn't mean that that's the only option. For some people, especially before they get to retirement age, if they want to take that life-only option because it looks good and it feels good, and they've got 6, 8, 10 years between now and retirement, their potentially highest earning years, and they're healthy, they may want to do something where they insure their own pension for their spouse. And so they say, I'm going to take the higher number, but while I'm working for these last 10 years, I'm going to fund a life insurance policy that is available to my spouse if I die. My spouse gets it. She gets enough money, or he, whoever, to live for the rest of her life. If they die too soon, I can always cash in the policy, but I still have my higher pension. And if we both die at the same time, or if I want to keep it even after my spouse passes away, my kids are guaranteed to get something. Because one of the big bugaboos about a pension is it's great for the person receiving the payment.
And the spouse
nothing left when they're gone.
Yeah.
If they get it. Yeah. But there's nothing left after they're gone.
No.
And so if you're trying to leave a legacy, doing something called, this pension maximization idea, if you're healthy, if you're doing it far enough in advance, if you have the money to do it, can be a reasonable option for that.
Yeah, the idea being, as you just said, you could take the higher life only. I have the pension. I decide, well, I have a pretty good I feel healthy. I think I'll live a long time. I'm going to take my life only, so when I die, my pension dies with me. But just in case my spouse, I'm going to fund, and this is a permanent life insurance policy we're talking about. This is a cash value, I should say.
I don't want to use that term because you could use a guaranteed universal life, which has basically no cash value.
But the
not
premium's
a term. Guaranteed.
Not a term policy is what we're talking about.
Or term to 100.
Well, yeah, you could do that.
If I make it to 100, well, if my spouse is still with me too, and I die, they're not getting anything.
Yeah, and I think at that age 100, you're probably fine with that at that point.
But that's what when you take that joint and survivor option. If my pension was $2,000 a month for my life only, but it was only call it $1,500 a month for 100% joint and survivor, what is that discount? That discount is a $500 in this hypothetical example premium that I am paying basically. So that if I die, $1,500 a month continues for my spouse.
Uh-huh.
I'm insuring it either by taking a lesser amount, or I can insure it by taking the full amount and paying a premium. One way or the other, I'm getting dinged one side or the other, but I have to do it.
Well,
if it's come to that conclusion.
And what you're talking about, as you said, is a pension maximization. This is kind of the official, unofficial title for this particular strategy. How often over the years have you done this pension maximization strategy for people, Professor?
Well, we don't see as many people with pensions anymore. Mm-hmm. And unfortunately, we don't see it done very often because by the time people get ready to do it, they're thinking about it. They don't think about it until the week before they retire. And unfortunately, by the time we're 65, 68, maybe our health isn't as good as we want to be able to get insurance. And so in some cases, it gets more expensive. That's why I said it's best done several years ahead of when you want to retire so that you get it in place and get it with the cheaper, younger rates than the older rates when you retire. But we've done it. I mean, I've done it a handful of times over my 100 years of whatever.
Well, it makes some of these decisions a little bit less. I don't want to say taxing because it's not tax. I'm just saying a little bit less stressful in some ways because I do know people who have really stressed over this whole decision on the pension thing, and they've earned it. They want to make it last absolutely as long as possible. And there's just no way without knowing how long you're going to live to do that. So you just have to make your best guesses. But this means that you've got to be informed as to what your actual decisions are. And as we've only gone through a couple of them, I mean, Rick, there's a lot of them. I mean,
the options, and that's why when it comes to your pension, we really need to look at the specifics of your pension. What options do you have? Like in anything else with planning, there's a lot of opportunities out there that have no bearing on you that you can't participate in. There's a lot of people maybe listening to this, or maybe they've already turned us off because they don't have pension options. And they're saying, why am I listening to this? Because I'm never going to have a pension option. And so, but if you do have that pension option, it's very variable as far as what your pension options are. So let's find out what works and doesn't work in your world and how to best use the options available to you. That's called planning. Oh, my gosh.
It is part of planning. And even for people who don't have pensions, I mean, there is something to be said for the importance of having some form of guaranteed income, guaranteed cash flow.
There is a psychological benefit for having direct income that the market can't change, income that I can't change. I can't mess up. So, and the idea is, we want to have enough direct income. When I say direct income, I'm talking about pensions, Social Security, other sources of cash flow that are outside of my control, basically. Pensions and Social Security, once I've turned them on, they're set, they're done. I want to have enough direct income to cover all of my basic living needs. Mortgage, rent, property tax, whatever, insurance, basic insurance, gas and electric, enough food to live. Maybe, okay, I'm not going out to Ruth's Chris every night, but just, food to be able to live. I want to, when I wake up in the morning, the way I look at it, when I wake up in the morning, I have expenses for the month. No matter what, I'm going to have some form of expenses somewhere. I want to have enough money coming in through over the threshold of the door to cover all those wake-up expenses and maybe some other basic expenses that I feel are necessary. Certain, travel for. I got to see my grandkids. That's my mental health. I got to have that done. So I want to have enough income to cover those, and I've met certain people that they were police officers, firefighters. They have pretty good pensions, and they retired, and they've got more pension and spousal and other Social Security coming in than they'll spend in a month ever. They don't need to be looking for more guaranteed income. On the other hand, I know a lot of business owners that have relatively small Social Securities because they've been working at keeping their FICA taxes low for all these years, and they didn't pay into Social Security that much. And as business owners, they didn't have the big retirement plans. They don't have the pensions. Where they built up their own net worth through the retirement plan. They don't have pensions, so their Social Security is not very big, and they don't have a pension. They could use some direct income. They may have a baseline of $5,000 a month, but between the two spouses, their Social Security may only be $2,000 a month. They would work. They should look into some kind of protected income for another $3,000 a month. It makes them better, more rational investors with the rest of their portfolio.
And I don't want
to. If I'm not worried about the market crashing tomorrow and my income stopping tomorrow, I'm less likely to freak out if the market crashes tomorrow.
Well, and what we've talked, we don't have time, unfortunately, today for this episode, but we've talked in the past about purchasing pensions. There are insurance companies that offer pension-like income that you can't outlive, that the markets can't mess up and all that stuff. And they are insurance-type products, but these are things that certain people perhaps could benefit from. Not everybody. Certainly not everybody. The people you just mentioned with more pension and Social Security money than they can spend in a month or a year. But there are certain people who should do this. And when we talk about things like pension, I just wanted to emphasize not just the importance of knowing which options are for people with pensions to take, but also the importance of having, as we said, that guaranteed income, that cash flow that you can't outlive.
It's helping us control our reaction to influences that we have no control over, the market movement.
Exactly. So these are the options that you have. There are so many different iterations of this, well, you can take, as you said, there's a pop-up option. You can
sometimes.
But there may be, but there may not be. There may be a lump sum option. There may not be. Usually there's a single life, and then there's for your spouse, there's a 100% joint and survivor, usually a 50%, some kind of joint and survivor option. But
if you're married, there is always a joint and survivor option. In fact, it's the mandatory option unless you can get your spouse to sign with a notary that they don't want that option.
Is it 100%? Is the default 100% joint and survivor? 50%. So the default is 50%. I know many married people who want to make this 100%. So when they actually
that's good.
Yeah, and so when they actually do this, when you actually sign up and say, I want to take my pension, you should make sure that they're getting the 100% joint and survivor if that's what it is you want. There are a whole bunch of different ways to do this. I wish we had time to get into more of them. If you have any questions about your your pensions, pension options, and things like that, or ways to have some form of guaranteed income, you can call the folks at Lucia Capital Group, 800-644-1150. They do these calculations, this planning all the time. 800-644-1150. It's an important decision. We said at the top of this podcast that these are decisions that you make one time, and you got to live with them. With regard to pensions especially. I mean, this is the decision you make when it's time to start taking your pension. And if you die too soon or the spouse dies too soon and you don't have the quote-unquote correct payment form, it could hurt you. And I know you've seen that too, Professor Plum.
Oh, yeah. I mean, you make your decision based on the best available information.
And you get that best available information.
Life changes.
Oh, it sure does.
Life changes.
It sure does. And that's why it's good to talk to a financial advisor about this, because they may have seen things happen that you hadn't considered and may be able to tell you some options that you hadn't considered for yourself. Talk to them at Lucia Capital Group, 800-644-1150. Go online, luciacap.com, LUCIACAP.com. Find some information on pensions out there. Not just pensions, but also forms of guaranteed income and how to create some of that what we hope is just a little bit more stable life mentally, where you don't have to worry about what happens if the market drops and I can't pay my bills. You don't want to do that. Go online, luciacap.com. You can also download any of our guides. We do have a Social Security guide. We have a retirement guide. We have a bucket strategy guide and a few other things, estate planning guide. Make sure you go there, go to the search bar, type in, Social Security or estate planning, and you'll be able to download the documents for free. Absolutely. And read them. Professor Plum, I thank you once again. This has been fun.
You're welcome.
I do enjoy talking about this, and thanks for returning for season whatever this is. I'm going to go back and find out. I don't know if we even keep track of that, but we've been doing this for a long time, and you've been here with me through that entire time. So thank you very much. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor. I didn't say that before, but I'm saying it now. I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. We'll talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Annuity protection guarantees are based on the claims paying ability of the issuing insurance company. No stock investment strategy or risk management technique can guarantee return or eliminate risk in all market environments. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial Insurance License number 0518721. LPLIA Insurance License number 0B91442.